Hey everyone, and welcome to this explainer. So, if you've been watching the financial news lately, you probably have a serious case of whiplash, right? Well, today we're going to cut right through all that noise. We're unpacking the fascinating and honestly super conflicting signals that are driving today's global market, just to figure out what is actually happening under the hood of the economy.
Let's dive right in with an absolutely massive number, 7,798.99. That represents the S&P 500 hitting its 27th, yes, 27th record close of the year. It's a staggering figure, especially when you think about the broader economic reality we're all navigating right now. Which brings us to the core mystery we're investigating today. How exactly are equities hitting these stratospheric highs when we've got persistently high interest rates, massive global supply chain friction, and all these looming political risks? I mean, it feels like a total paradox, doesn't it? The market is soaring, but the underlying ice, well, it's looking pretty thin.
To make sense of this giant puzzle, here's our roadmap for today. We'll start with the macro weather report, move into the corporate confidence anomaly, check out hidden market friction points, track some smart money moves, and wrap up with looming horizon risks. All right, Section 1, the macro weather report. We've got two completely different economic stories playing out at the exact same time. Let's start with the good news, which is all about inflation. The Producer Price Index, or PPI, is totally flat month over month. That beats expectations, mostly thanks to a 3.1% drop in energy costs. At the same time, the Consumer Price Index, the CPI, has slowed down to an annual rate of 3.4%. Because everyday prices are finally moderating, the market-implied odds of a September Fed rate hike have just plummeted, down to a mere 30%. This cooling inflation takes a huge weight off the Federal Reserve's shoulders, acting like a massive tailwind pushing equities higher. But, and there's always a but, right? Beneath that rosy surface, we have a really stubborn problem. The 10-year Treasury yield is sitting uncomfortably high at 4.66%. What's driving that? Basically, lingering long-term inflation fears and a really heavy supply of debt. Now, the absolutely crucial threshold to keep your eye on here is that 4.3% mark. Historically, when yields sit below 4.3%, let's call that the safe zone. Rising yields actually point to faster economic growth, and equities rise right along with them. But at 4.66%, we are well out of the safe zone. Once yields cross that 4.3% line, the whole dynamic flips upside down. It totally chokes risk appetite, dramatically spikes borrowing costs, and weighs super heavily on corporate valuations. Moving on to Section 2, the corporate confidence anomaly. Let's look at how companies are completely defying the cycle despite those high borrowing costs. To really get this, we first need to understand something called the bar lowering trap. Normally, in a late cycle market like the one we're in right now, executives do this thing where they intentionally talk down their public expectations. They lower the bar on purpose so that when earnings season actually rolls around, they can easily just step right over it and report a so-called surprise beat. But today, we are witnessing a profound anomaly. The rolling average of positive to negative earnings guidance is actually sitting near a 4-year high. We literally haven't seen levels like this since the initial post-COVID bounce back. Companies are essentially refusing to lower the bar. Instead, they're voluntarily raising their future guidance, which signals this deep systemic confidence in their own fundamentals. They're completely ignoring standard post-recession playbooks. And when you look at how the market is reacting to specific earnings, its priority is crystal clear. It is incredibly hungry for margin expansion. For instance, Airbnb saw a massive 17% surge, their best in 5 years, driven largely by Gen Z growth. Garmin jumped 16% thanks to impressive gross margins, and Starbucks even saw North American margin improvements. But hear this, the market is ruthlessly penalizing even tiny misses. Applied Materials actually beat revenue estimates, but because they failed to clear these super lofty AI expectations, they dropped 5%. And Tapestry, the luxury retailer, saw a 9% revenue bump, but missed their midpoint guidance by just a hair, resulting in a crushing 16.5% drop. Seriously right now, margins are everything. Okay, on to Section 3, hidden market friction points, specifically focusing on logistics and AI. So there's this massive hidden friction point going on right now with tariff evasion. For years, importers have used a loophole where goods are transshipped from China through places like Vietnam before hitting the U.S., purely to dodge Section 301 tariffs. The cost of this loophole? An estimated $60 billion in lost tariff revenue in just the last year. But the game is changing, fast. The U.S. is rolling out something called Project Detective Border. It uses AI to deeply analyze global routing histories to catch data inconsistencies. and that leads to strict enforcement, alerting trade partners and slapping higher tariffs on non-compliant nations. This AI-powered crackdown, it is going to seriously hike up costs for a lot of importers overnight.
At the very same time, we've got severe physical friction in the supply chain. Massive, unbalanced trade flows are just overwhelming Asian ports like Shanghai, and this congestion triggers a whole chain reaction. First, spot rates spike. The Sonic Shares Global Shipping ETF is actually up 44% year to date. This creates a really stark divide. On one hand, it massively expands margins for air freighters like FedEx and UPS, who suddenly have incredible pricing power. But on the other hand, it severely compresses margins for big box retailers. Places like Walmart and Target are having to bring in their holiday inventory months early just to avoid delays. That skyrockets their warehousing costs and eats right into their profits. Bottom line, you might actually feel this friction in your wallet when you start your holiday shopping. Let's look at Section 4, tracking smart money moves through the latest Q2 13F allocations. So when we peek at the recent Q2 13F filings, which basically show us what the heavy hitters are holding, we see two wildly different strategies. Take Warren Buffett's Berkshire Hathaway. They are scooping up tech infrastructure like crazy. They bought up $10 billion in Alphabet shares right as Google is hunting for massive AI capital. And rumor has it they're eyeing a new position in Microsoft too. Now, contrast that with Bill Ackman's Pershing Square. He is playing a totally different game, platform consolidation. Ackman went heavy back into Netflix, straight up declaring they've effectively won the streaming wars, and he added legacy payment giants Visa and MasterCard, all while dumping Hertz after a pretty bungled offering. It's essentially a tale of two philosophies, betting on the underlying plumbing of AI versus betting on dominant consumer platforms. And we're seeing these rapid, high-stakes shifts rippling out through the fringes of the broader tech sector too. Just look at Workday. Their stock popped 18% purely off private equity buyout rumors from Silver Lake, and that lifted other software peers right along with it. But man, contrast that excitement with a brutal reality happening in hardware. A company called InVenture watched its stock plunge 46% after they were forced to completely withdraw guidance for their data center liquid cooling business. Why? Because the AI market is just shifting too unpredictably. The smart money is moving incredibly fast right now, and the penalty for being caught on the wrong side of a trend, it's steeper than ever. Finally, Section 5, looming horizon risks. Let's look at the upcoming tests for this famous soft landing. The immediate hurdles, well, they arrive bright and early this coming Friday. At 8:30 a.m., we get the July retail sales numbers, and the consensus is expecting a tiny 0.1% growth, which would be a slowdown from June. Then at 10 a.m., the University of Michigan consumer sentiment data drops. That's expected to come in at a 54.5 reading, down a point from last month. Guys, these aren't just abstract numbers. They are the critical, real-world tests to see if this whole soft landing narrative is actually holding up for the everyday shopper. If these numbers miss the mark by a lot, that rock-solid corporate confidence we talked about earlier, it could just evaporate overnight. And I want to leave you with one final kind of provocative thought. As we just saw, consumer resilience is definitely being tested. But there is this huge, unpriced variable just waiting in the wings right now, shifting political capital. With major financial moves happening in the political sphere, like Elon Musk's reported $100 million pledge to help Republicans hold Congress, alongside all this tech capital realigning through back-channel diplomacy, we have to ask ourselves a huge question. Will this political wildcard, which could totally rewrite tech regulation and EV tax credits ahead of November, ultimately outweigh consumer resilience in deciding our economic future? Keep your eyes glued to the data this Friday, and seriously, watch those margins closely. Thanks so much for joining this explainer, and as always, keep learning.